Yeah, we should be able to round it up today. And then I will make the promise, but if we can have another class this week so that we can quickly round up on consolidated POL. That one shouldn't take us long to finish. All right. They say it, and colleagues in the house. I hope you guys have broken your fast. But Aisha, have you had your what is it called now? Is this or have you broken your fast? I'm not sure she's here. Okay, this is also an opportunity for me to sincerely apologize for how last week went. I hope I am being heard. I'm very sorry we could not have our class last week. All right, let's get into it. IAS 28. We looked at this last week. We introduced ourselves to it. By and large, I have always said it in this class that if we have an investment that is greater than 20%, but less between 20%, but less than 50%, such investment is what we call investment in associates, all right? And how you're going to account for an investment in an associate is definitely different from how you would do it if it were subsidiary. We said for subsidiary, we're expected to do full consolidation. That it does not matter that the parent company does not own all the equity interest of the subsidiary. The expectation remains that even at that, the fact that the parent has surpassed the 50% threshold, and by all means and all other indications, we have seen that that company is a parent company, then the responsibility to consolidate the books of that parent company and that of the subsidiary will now go to that company. All right. And what is full consolidation? It simply means that we are going to add up line by line items. Line by line items, with the exception of transactions that has occurred between the group or within the group. And what are the transactions at the level of this course or this paper that may exist between the two companies, that is the parent and the subsidiary? We said the first one will be at the point of acquisition, when the parent company would have transferred the consideration to the subsidiary. We said this sort of transaction ought to be cancelled out. We said further that in a case where there is transaction between them such that there is an account payable balance in the book of one, and for the same transaction, there is an account receivable in the book of the other company that belong to the same group, what do? You cancel out as well. We went further to say if there is any transfer of goods, inventory, for which the selling party had, put a profit loading on, and we find out that such inventory still remains in the book of the buying party, in as much as they are within the same group, whether it is parents that sold to subsidiary or whether it is subsidiary that sold to the parent, we are going to eliminate the unrealized profit. All right. That is another transaction between the both that can occur between the both of them. We went further to talk about non-current assets. There could be a transfer of non-current assets also with a profit loading, in as much as that non-current asset remains in the book of the either party. What you're always going to do is you're going to cancel out those unrealized profit or gain on disposal or transfer of non-current assets, whichever one applies. And we also said that should it happen that there is an element of depreciation, that element of depreciation that would have been expensed in the book of the buying party would also be eliminated, meaning that we are going to add back such depreciation expense. All right. Now that is all that we have done so far. That is all I have summarized. Said you have to cancel out transactions that takes place between these parties, and then you consolidate line by line every other item. Something else that I could say you could also watch out for is adjustments that could have taken place that should have taken place at the point of acquisition. You said you could be told that there is a brand name that the company, the buying company, the acquirer is paying for. So therefore, that should also come into the calculation of the goodwill at the point of acquisition. Now, that is what we've done so far. But tonight, we're not looking at parent-subsidiary relationship. Rather, what we're looking at is the situation where the equity investment, like I mentioned earlier, is equal to or greater than 20%. However, it is less than 50%. Now, this may be the case, and yet it will not be accounted for as an investment in associate. Let me repeat that. Even when this is the threshold, all right, even when the equity investment is within this threshold, there is the possibility that it may not be accounted for as an investment in equity, investment in associate. Now, how is investment in associate accounted for? First of all, investment in associate will be accounted for using what is called the equity method of accounting. The equity method of accounting, meaning we are not going to do full consolidation. Instead, what we are going to do is that we are going to increase our investments in associates. We are going to increase our investments in associates with the share of profit in associates. With the share of profit in associates minus any impairments. Any impairment on this investment. That is all we are going to do. We are going to increase our investment in associates by adding the share of profit in associates and deducting any impairment on the investment. All right? So it simply means that from the inception, when we invested in associates, we would have debited assets, investment in associates. And we would have credited bank. All right? This is at the point where we have made the investment. Now, going forward, What I mean by equity method is that we will now debit investment in associates, and credit POL. Meanwhile, if we are dealing with statement of financial position, we would credit retained earnings. Like I mentioned to you previously, that the representation of your POL in your statement of financial position is the retained earnings. Okay, so now what if we had to make an impairment? It's the same thing. The only thing is that this would have reduced our profit. So in the book of the parent, you debit POL, you credit investment in associates, and you do the same thing for the group. It's meaning you are debiting the group POL and you are crediting the investment in associates. All right. Give me a moment, please. Give me a moment, please. Right. Sorry, I had to do something there. I'm very sorry. Now let's move on with the class. So this is by and large all that we want to do today. But let's get into the bigger details of things. We already went through the cases of exemption last week. So I'll just move on so that we can possibly complete what we have in front of us. All right, let's look at this problem that we have here. We are told that PICO, a company with subsidiaries, acquires 50,000. Let me put them back. So a company with subsidiaries acquires 50,000 of the 20,000 ₦1 ordinary shares in ECO for 120,000 naira on 1st January 2017. In the year to 31st December 2017, ECO earns profit after tax of 48,000 naira, from which it pays a dividend of 12,000 naira. Now you're asked, how will ECO's results be accounted for in the separate and consolidated accounts of PICO for the year ended 31st December 2017? All right. All right, let's look at this together. Okay, all this lengthy solution. Let's look at it together. First of all, in the separate book of PICO, in the separate book of the parents, and then we'll look at it from the perspective of the group. Now, you will treat ECO as part of the group, only that ECO will be treated as an associate, investment in associate. I'll come back to this. First of all, let's determine what is the percentage holding. Percentage holding will be they acquired 50,000 shares out of the 200,000 shares. All right. times 100. This is 1/4, and it should be equals to 25%. You will agree with me that 25% falls between the threshold of greater than or equals to 20%, but less than 50%. All right? Now, should that be the case, then PICO's investment in ECO qualifies for equity method of accounting and not full consolidation, because this means that PICO has made an investment in associates. All right? So therefore, what we will do is this, to say how much has the historical amount that PICO invested. The historical amount they invested is 120,000. This means in the book of PICO, we are going to have to debit investment in ECO. How much? 120,000. We are going to have to credit bank. How much? 120,000. All right? As straightforward and as simple as that. Now, the day that dividend was declared and dividend was paid to PICO, PICO will say, out of the 12,000 naira that was the dividend that ECO paid, PICO will get 25% of this 12,000. Now, 25% of 12,000 will equal 3,000 naira, because that's 1/4 of 12,000. So therefore, what will PICO do? PICO will say, I have received cash. That must have gone to their bank account. They have received 3,000 naira. All right. Now, they will now go ahead and do what? And credit. What amount? They will credit P or L 3,000 naira. All right. This is very straightforward. In the book of the parent, on their SOPL, they are going to have, at the point when they bought, SOPFP, rather, they would have had how much? Investment in ECO, 120,000. At the end of the year, their SOPL, they're going to have share of profit in associates. How much? 3,000. This is the separate book. When it comes to group, and this is what we refer to as equity accounting now, they will also have had SOFP, investment in ECO, same amount, 120,000. All right. However, when we want to recognize this profit, they made a profit after tax of 48,000 naira. What we will do is to say 25% of this 48,000. 25% of 48,000, that looks like 12,000 to me, because that's 1/4 times 48,000. 12,000. All right. Now, this 12,000 will be added to this investment. Meaning that what they are going to have in their SOFP as investments in ECO will now be 132,000. Now, this 12,000 This is the whole of what is due to them.
Once you're doing a loss calculation, you're supposed to use a white marker board or a separate Excel sheet to show your calculations. And it's not to
what we now have
it makes no sense.
For what is due to PICO from all of this 48,000 profit will now go to their retained earnings. It will go to their retained earnings. All right? This will go to their retained earnings. Somebody is speaking. Can I hear you, please? Hello? I can hear somebody speaking in the background. All right. Do we understand this? Before I move further, is this clear?
No. Hello?
Hello, what is the part that is missing? What is not clear?
Hey, I'm a bit confused. When you calculated the 12% of the profit and we added it to the statement of financial position of the group, how come we are now adding it again as retained earnings?
I'm a bit confused.
25% of 48,000. You did that, right? And
yes.
it was added to 120,000. As this SO profits, I don't know, SOPIA.
Okay, you know what? Let's take it somewhere I can do it more clearly. I'm coming. Let me use the whiteboard so that you can get me more clearly.
Okay.
So this is what I'm saying. I want you to have two mindsets. They may and they may not ask you in your exam to do this accounting for the separate book. Now, if you notice, in all of the questions we have been dealing with, you will always see that investment that the parent company made. I know this is an associate, but look at it from that angle. Now, all of the questions we have solved, when we are looking at the separate book of the parents, the investments they made, the equity investments they made, is always at the historical amount. Whenever you look at that question, you will see it. They will write it there. Investment, whether it is ESCO. Whether it is ESCO, for instance, they will say investment in ESCO. Maybe like, let's say 200,000. Now what this is the historical amount that they paid. Meaning that all their entitlements, all the profit that should accrue to them, or that is paid, or the dividends that are paid to them are not brought here. Instead, they would have a separate line on the SOPL, dividend received, or something like that. Those dividends will go there. Do you understand what I'm saying? This is separate book, all right? Which is why when we were accounting for this investment in the case of this question, they said they made an investment of 120,000 naira. So this is separate book. Book of PICO. All right. They made an investment of 12,000 naira. So that investment in their SOFP, you will have investment in ECO rather, to the tune of 120,000 naira. This is their SOFP. In their SOPL, it's straightforward. The company paid, ECO paid, dividend ECO paid, all the dividend together was 12,000 naira. You and I have agreed that the investment that PICO made in this associate is what they bought 50,000 out of 200,000. If you multiply that by 12,000, what you will get is 3,000 naira. They must have received this in their bank account. Abi? So they would have done debit bank and then credit POL. All right? So this will be dividend, yeah? How much? 3,000. Now this is straight to the point. Very, very easy. The other leg for this 120 would have gone to the bank account. Abi? All right. Now, if that is, okay, if I want to show bank, let's assume that that is all they did with their bank account. That bank would have been reading 120 minus, minus 120, they paid 120, they received 3,000. But I don't need to show you balance for bank. Of course, there must have been other transactions that went into the bank, but this would remain at the historical purchase consideration. All right? Now, if it was consolidated account we are dealing with, like I said, they are not going to consolidate the book of ECO with that of PICO. What they will do is to say, how much have we invested? Like I mentioned earlier, they invested investment in ECO. Investment in ECO was 120,000. 120,000. Now, the profit, share of profit in ECO will be 25%. 25% of 48,000. All right? If you add this 12,000, this is how their investment will grow to 132,000. Now, they received dividend. I explained up to this point. Is this clear? Is this clear? This 132,000 I have done here. Is this clear?
Yes.
All right. So don't forget that if you are dealing with SOFP, you would have to take to retained earnings this 3,000 that they have just received. All right. Now, the second leg for this 3,000 is that they receive dividend out of all the money that they accrued. All right. Out of all the money that they accrued, they received 3,000. Everything that is due to them is actually 12,000. All right. It is just that the company paid dividend on an amount that is less than all the 48,000 that they made. That is, ECO did not distribute all the profits as dividend. Now, if ECO had distributed all the profit they made, all the 48,000 naira they made as dividend, they would have received 12,000 naira. It is that 12,000 naira that you have gone ahead to accrue as part of their investment in ECO. Now, you must understand that you are not going to do that when you are accounting in the separate book of PICO. You will not do that. You will just let that investment remain at its historical value. Now, what makes equity accounting is what we are doing now, by recognizing all that is due to PICO from that 48,000. 12,000 is due to PICO. So we'll recognize that 12,000. Now that they have received 3,000 out of the 12,000, I cannot continue to carry 12,000. So I will deduct that 3,000, and what I'll be left with is 129,000. So this will be the carrying amount of their investment in ECO. So meaning that when I am dealing with consolidated SOFP, which is what the examiner will most likely set for you, but like I have mentioned, they may decide to test your knowledge on, it is not even a test of knowledge, it is just something that happens to students. You get carried away with learning all of the things you're supposed to do in consolidated. If they had not taught you consolidated, you would have done the right thing for separate book. And the examiner knows this trick that happens with students. So what they will do is present you an opportunity to show us whether you pay cognizance to the fact that in the separate book, we will not have accounted for it as though it is equity method. What we would have done in the separate book is to let that asset, that investment in associates, remain at the historical amount, whilst we will continue to recognize the dividend that we have paid in our income. It's just like any other investment in equity. That's what you are going to do. You will say, I have equity investment, asset, bam. Anytime you receive dividend, what happens? You take it to your income and then you debit your bank. If you are accounting for it using, what is it called now? If you are accounting for it using fair value through P or L, you know that from time to time, you are going to, which is going to even be the case, from time to time, you are going to be revaluing the equity. And as you are revaluing the equity, the increases or decreases in the value of the equity will go to P or L, whilst those increases will also now increase your investment, so that your investment is shown at the current value. Except for that, you will let it remain at the amount that you bought it historically. So it's quite straightforward. It's quite straightforward in terms of what they have asked us to do here. So I'll ask again, is this clear before we move forward?
Yes.
All right. Okay, so now let's move forward. Maybe I shouldn't even bother taking it back, but okay. We may have one or two students and some students who would rely on this. Okay, so let's go back to our material. All right. Now you will see the same thing was done. So the group share of return is this 9,000, and we all know how this 9,000 came to be. We had accrued 12,000 before, and then we received 3,000. So it's as good as saying I would have credited group retained earnings with 12,000. Then in accounting for the 3,000 that we have also received, we also now take out that 3,000 here. And that will give us 9. All right. Meaning the equity, the accounting, the double entry for this 3,000 would have been that what we did, we reduced investment in associates, and now we are reducing group retained earnings. So debit group retained earnings, credit inventory, investment equal, sorry. So we move forward from there. And then you come and look at what they have here as carrying amount of the investment, 129,000. All right. Let's look at what they said we should note here. They said dividend received from associates is deducted because it is an intra-group transaction which should not be consolidated. Will only be included in the separate account of the investor. So that's another angle to look at it. You can look at it that you had earlier accrued it, and now that you have received it, it should go out. And you can also look at it from the angle of the fact that the associate, like I mentioned, is now a part of the group. So therefore, if there is a transaction between the group, like I mentioned when we started the class, all of that must be cancelled out. All right. Let's look at problem number 2. Problem number 2, moving on. 1st of January 2017, Pico bought 25% shareholding in ACO at a cost of 76,000. 1st December 2017. ACO made a profit before tax of 164,000. And the taxation charge on the year's profit was 64,000 naira. Okay. A dividend of 40,000 naira was paid on December 31st December 2017 out of the profit. Calculate the entries for the associate, which would appear in Pico Group. All right. Let's make sense of the workings together. All right. Okay. Let's make sense of it together. All the profit that was made, profit before tax, was 164,000. All right. Then tax itself was 64,000, meaning that all the profit after tax, profit after tax must have been 100,000. Right, we'll come back to this. Out of this, a dividend of 40,000 was paid. 40,000 naira dividend was paid. We'll come back to this. All right. Okay, the percentage of their holding is 25%. All right. And they bought that at 76,000. If you go by what I have said earlier, investment in ACO, where did they even say we should show this? Okay, let me just use once and for all. Let me use a whiteboard. Okay, so we're told investment. I can do this extract of SOFE will look like this. Investment in ACO. And then we're going to have the group retained earnings as well. Right, I'll come back to this. Let's do our calculation. Investment in ECO, how much? Share of profit in associates, how much? And then we receive dividends. Dividend received, how much? This will give me carrying amount of investment in ECO. All right. How much did we invest? We invest 76,000. Now, of ECO, we said it should be 100,000. All right. 100,000. Profit before tax. How did we get it? Profit before tax was 164,000. Tax in itself was 64,000. Profit after tax was 100,000. All right. So share of profits in ECO after tax. All right. So profit after tax was 25,000. Therefore, all our investments will then rally up to how much? All our investments will rally up to 101 ECO pay. Total dividend paid by ECO is equal to how much? We're told they paid 40,000 naira. All right. Now, dividend that would have been allotted to PICO will be equals to 25% of the total dividend that was paid. That's like 1/4, right? 1/4 of 40,000 should be 10,000 naira. And that should leave us with, is it 91? Yeah, 91,000 naira. All right. So it's as simple and as straightforward as that. So your group retained earnings, you would have accrued, I still want to write 12,000 again, God forgive me. All right, where's my eraser? You would have accrued the 25,000. The second leg of that 25,000 would have come to retained earnings, while the second leg of the dividend received, which is how much? 10,000, would also have come here. So all the retained earnings that came, the growth in retained earnings that will come from investment in associates will be 15,000. Our investment, we'll use the carrying amount. Don't forget, when you are dealing with the consolidated, it's the carrying amount that you're going to use, not the historical amount. Is this straightforward as well? I think it is. Is this clear?
Yes.
All right, thank you. Do we all have access to the material so that I don't need to go back again? everything we want to learn tonight, we can round up sharply. In as much as I don't have to go back to the material, we can just move on. Do we all have the material?
Yes, sir. I do.
All right, let's use the chat box. If you do, just type yes. If you have access to the material, just type yes, so I know whether to go back or not. All right, so many yeses so far. All right, okay, let's move on then so that we can round up fast. Okay, problem number 3, we have to do a simple consolidation that involves an associate or investment in associate. Winner, they just said no. Winner, they just said no. So what I would do for you is this. Let me do something I've done with the CR students. All right, let's get back to it. I'll share the next part of the screenshot now. And then we can get back into it. Problem solved. I'll say, I think so. Problem has been solved. So let's get back to the whiteboard. So Winner Adejo, you can use the screenshot I've sent to write back into what we are doing. All right. Okay, now let's get with it. We're told we have a problem here. Simple consolidation, but involving investment in associates. All right, set out below are the accounts of parent co and its associates and of associate co. Parent co acquires 40% of the equity capital of associate co 5 years ago when the latter's reserves stood at 20,000. So when they say when the latter, so they are referring to associate co when they said the latter. All right, let's move on. And then we're given the SOFP and the SOPL. And then we're asked to prepare the consolidated accounts of PICO. Consolidated accounts of PICO. All right. So you will notice here that the book of parent and subsidiary has already been consolidated. This will not be the case in your exam. I very much doubt that. They would have already helped you to consolidate. It will happen now. What is likelier to happen in your exam is that you're going to be given a question to do where you would have to consolidate, first of all, parent and subsidiary, and at the same time, use equity method to account for investment in associates. So it's a combination of the two, most likely. However, they have decided to make life easy for us so as to just make us see the building block step that we are expected to take here. So let's take it one by one. All right. I don't need to bother myself about a lot of things. I am not going to be consolidating those numbers, apart from what has already been consolidated. So I'm just going to say here, parent co consolidated statement of financial position as of when? As of, they didn't tell us as of when. All right, I can say as of today. All right, so for assets, tangible non-current assets. I am not adding anything together. What needs to be added has already been added. Are you with me? What needs to be added has already been added. However, when I get to investment, in associates, what am I supposed to do there? How much was the investment when we bought the investment? Investment in associates is still showing the historical amount. And why? Because we are yet to use equity method to account for investment in associates. All we have done is simply consolidate the parent and the subsidiary. And so if the parent already has investment in subsidiary and we are yet to use equity method, you will still see that 30,000. All right? And let's get into it. How much was the profit? How much was the profit? All of the profit that the associates made during the period. You go to the SOPL of the associate pool, you see there 25,000. All right, they made 25,000. So we're expected to get 40% of this 25,000. We're expected to get 40% of this 25,000. However, mind you, you were also told that after the day when the parents bought ECO, all their reserves, all the reserves, pre-acquisition reserve was 20,000 naira. Now, what is this reserve? If you go into the statement of financial position, the only reserve they have is retained earnings, meaning that if they now have a retained earnings that is equal to 50,000, 20,000 was pre-acquisition. Abi, the remaining 30,000 is post-acquisition. All right. So if in the current year they made 25,000, it means that from previous years they must have had 5,000 naira. All right. So the 40% of 25,000 is speaking to current year. Let me erase this multiplication. What I wanted to write, or what I must have tried to write there, is plus, not times. So I can still say plus 40% of 5. And then I close my bracket. All right. It's still the same thing as saying 40% of 30,000. Is this clear before I move forward? Is this clear, my students? Is this clear? You can use the chat box so I know we are following. Is this clear? Are we in this class? Is this clear? Oh, this breakdown I did here, is it clear?
It's not clear.
Okay. Alternatively, look at what we could have done. We could have said 30 plus what is the post acquisition? I mean, what is all the retained earnings they have? 50, Abi. What is the pre-acquisition? 20, Abi. Multiply by 40%. How about do it like this? Is this clear? Is it clear like this?
Yes, sir.
All right. So it's following the same logic we have always used. The parent or the investor in associate will only get, any investor in equity will only get profit after the day that they have made that investment. They won't get it into the days that they had not made the investment. So they had not made the investment when the company, when associate co made that rate. All right, so they don't have that. So if you do 40% of this 30, you get 12. If you add 12 to 30, you get 42. All right, the other things, we just put them there. Loan to associate co.
We can't hear you. Your voice has been breaking up.
All right, how about now? Can you hear me now?
Yes.
All right, good. Loan to associate co. Current assets. You can see I'm not adding up anything again. I am not adding up any other thing that belongs to associate. I'm not adding them. All right. And then we'll come to equities. Ordinary share capital. I'm sure this is for the parent alone. How much is that? 125. And then we'll come to retained earnings as well. Who is trying to write on my board? Aisha, are you trying to write on my board?
Sorry, no. I mistakenly pressed the edit button, so I was trying to switch it off.
All right. All right. Now, the retained earnings of PICO alone is 75. Don't forget, we had a 12 from here. I mean, 40% of 30. That 12 will come here. You have 87 here. And then that totals how much? 2, 1, 2. The same thing will occur here. 5, 6, 11, 2, 1, 2. All right. So that's that about that. Okay. What we have just done here is to show a very simple scenario. like I mentioned earlier, a very simple scenario. Very simple scenario. What makes it simple? The consolidation of the parent and the subsidiary has already been done. All right. So let's move forward. So briefly, I would just like to share, briefly go back to the notes. Sorry. Briefly. So when we come back to the notes, the next thing is intra-group transaction. I want to use this explanation. I want to use this explanation. All right. So we could also have intra-group transaction. So what we do here is whenever you have sale of goods, whether it is from the associate to the investor, or it is from the investor to the associate. Any profit or loss resulting from these transactions are eliminated to the extent of the investor's interest in the associate. And I said it is important to remember that only the group share of the profit or losses will be eliminated. Now, what they are trying to say here is this. What they mean by this is this, that this does not come into play when you are dealing with the separate books. And it's the same thing when we talk about parent and subsidiary. It is not that parent and subsidiary cannot have transactions. They can. In their separate books, are you eliminating anything? No, you are not eliminating anything. No. If they sold to each other at a profit, then it will be recognized as a profit. Mind you, it is one of the reasons why government is paying close attention through the tax authority. They are paying close attention to transfer pricing, because a whole lot of shenanigans can be done around that transaction, in the sense that they can create a fictitious profit. Let's just create a fictitious transaction such that the subsidiary will say, oh, I had a trading, I had a transaction to do with the parent. Or they could also create a situation whereby they can, create a fictitious transaction that would hide profits. Okay? What am I trying to say in all of this is that in the separate books, no problem. No need to eliminate. But when we come to consolidation, like we have said earlier, that intra-group transactions will be eliminated. Now that is going to happen to the extent of the investor's interest in the associate. All right, let's see the example that we have here, problem 4. For problem 4, we were told that PICO owes 25% of the equity of ACO during the year. PICO sells 500,000 naira worth of goods to ACO at a cost plus of 25% markup. All right. At the end of the year, ACO has all these goods still in inventory. Like we have said, if we still have any item of inventory, there was a transaction between them, still in the books, what do? You simply eliminate. Now, I don't know if it was this class I was trying to explain margin and markup to. Okay? And this would be a very good opportunity. A very good opportunity for me to explain this, all right? A very good opportunity for me to explain conversion of markup to margin, okay? Now, why do we have to do a conversion? Let me start like this. Whenever you are told that a profit is markup, if a profit is a markup, it means that you are dealing with profits all over costs. We have given you a percentage of profits all over cost. We are saying out of the cost, profit accounts for so percentage. Profit accounts for this percentage out of cost, and that is from all the cost that was incurred. Now, whenever that is done, that profit is assumed to be a loading on the cost, meaning that whatever that cost is, that profit is, we'll add it to cost to get selling price. I'm going to come back to that. But when they tell you profit is margin, margin is sales. So profit all over sales. Now, if selling price is cost plus profit, you will agree with me that profit margin is also profit plus cost plus profit. Is this clear? You can use the chat box to say it is clear or not. Is this clear? I'm not seeing anything. I will assume that it is clear to all of us.
The explanation of the margin is not so clear.
Okay. Margin, anytime you hear margin in accounting, you are referring to sales. If you are doing performance management, or you wrote management information, they would have told you margin of safety, they would have mentioned contribution to margin. Anywhere they mention margin, you will just realize that that thing will be related to sales, okay? So margin is sales, all right? Now, if margin is sales, they say profit margin, they are referring to profit all over sales, all right? Now, when they are referring to profit all over sales, remember I told you that your selling price or your sales is the addition of cost and profit. I'm now saying, therefore, profit margin is always profit all over cost plus profit. Is this clear now?
Yes.
All right. So can I go ahead and also come here and say, if selling price is cost plus profit, then if I want to get cost, I can also get cost by saying selling price minus profit, right? I can say selling price minus profit. So this one too, I can say this is also profit all over sales minus profit. As simple as that. All right? So when the examiner gives me, what the examiner will do to you is this. They know you may not pay attention to it. They will give you sales and give you markup. Now, I cannot apply this 25% to this 500,000. You know why? The 500,000 is sales. The 25% is a markup, meaning it is a percentage of cost, not of sales. If they told me 25% margin, then I can apply this 25% on this 500,000 and I will get my profit. But they have told me that it is a cost plus. They even told me it's a cost plus. 25% markup. So I cannot apply 25% on sales. All right. Another thing examiner can do is they will give you costs. They will now give you margin, profit margin. Now that margin is a percentage of sales, not of cost. So therefore, I must be able to switch between markup and margin. All right. And to do that is easy. Examiner here gave me 25%. So what I will do is this. I will say, you gave me 25%. If you gave me 25%, 25% is 25 over 100, all right? And markup is profit all over what? All over cost. Now, that is what my markup is. My cost is 100, my profit is 25. That's how I'm going to work with it. If I want to convert to margin, what do I do to get sales? I will add cost plus profit. So I'll come here and say cost 25, cost plus profit. Cost is still 25, profit is 25, cost is 100. So this is 25 all over 125. It is this I am going to apply on 500,000. All right. So that is how I'm going to get the amount of the profit. Now somebody help us do this without wasting time. 25 out of 125 is 5. 500,000 divided by that 5 is 100,000. So our profit is 100,000. Is this clear?
Yes, sir.
All right.
Yes.
So quickly, let's see how it was treated. How was this treated? We're told that note, markup, okay, blah, 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 blah. I'm going to leave it at that. And say, I haven't determined the profits made by PICO. The intragroup profit will be to the extent of the group share or the investor's interest in associates. And group share in ACO is 25%. So we will only calculate 25% of 100,000. Let me explain what they are saying here. When you come back here, no, I said, okay. When you come back here, all of this profit, all of this profit, 100,000, is what was realized, right? But don't forget what we said here. We said you will eliminate to the tune of the investor's holding or interest. The investor interest, we're told PICO owes 25%. So my elimination will be based on this 25% of 100,000, which will now give me 25,000 naira. All right. Now let's go further down and see what other direction the note is giving us. Okay. We're now told that since all the goods are still in inventory, the unrealized profit is the same as the intragroup profit of 25,000, which will now be eliminated. Now, since it was the parent or the investor, but it's not a parent in this instance, to the associate. But since it was the parent, we're going to debit. This is very straightforward. Group retained earnings and credit their investment, the carrying amount of the investment. Now, Pay attention to this. I have mentioned this before. If it was subsidiary, it will still come here. It is still going to be group retained earnings. The only difference is that if it was subsidiary and the person who made the profit, who made the unrealized profit, was the subsidiary, we would have shared between parents and NCI. So for parents, it would have been debit group retained earnings. The remaining portion would have been debit NCI. Is this clear? Is this clear? Before I move to the other point. All right. Now, what this note is talking about is this. When we were treating group, if parents made a sale and there is a profit loading on it to the subsidiary, what we would have done was debit group retained earnings, credit inventory. But now you are not going to credit inventory. You know why? Because the inventory is not fully consolidated for associate investments. We are not adding line by line item. The only thing that represents your plus and minus is the carrying amount of investment in associates. All your adjustments goes there. All your adjustment goes there. So anything that is supposed to increase my investment in associate will be an addition to investment associate. Any adjustment will be any other adjustment will be a deduction from it. And then the other leg will be going to my group retained earnings. All right. So that is what is going to take place and that is why it is quite straightforward. Okay, let's look at the next problem so that you will understand what we are saying here. All right. The next problem is a typical question. So let's quickly go into it. More likely than not, we'll need to use whiteboard for this. So let me quickly do the screenshots. Now, let's read the question. We're told that the statement of financial position of PICO and its investee companies, ESCO and JCO at 31st December 2017 as shown below. Now, PICO acquired 1.2 million of investment of shares rather in ESCO for 2 million naira when the retained earnings were 400,000. Now, at the date of acquisition of ESCO, the fair value of its freehold property was considered to be 800,000 naira, greater than its value in ESCO financial position. Now, the building element comprising of 50% of the total value has a remaining useful life of 50 years. All right. Okay, as I'm reading this, I think I'll be speaking to one or two things there. For this one, we know that that's an adjustment. So we already know that what would happen is that would be an adjustment. That 800,000 will be an adjustment that will deal with at the point where we are making where we are calculating goodwill on consolidation. The only thing there is that there's going to be an element of depreciation that we are going to deal with for the building. All right, let's move on. We're also told that Pico acquired 450,000 naira worth of investment, ordinary shares in JCO on January 1st, 2016. For 1 million naira when the retained earnings of JCO was 300,000 naira. D. ESCO manufactures a component used by JCO and PICO. ESCO sells this component at cost plus 25%. Now, PICO held 200,000 naira inventory of this component as at 31st December 2017. In the same period, PICO sold goods to JCO of which JCO had 160,000 naira in inventory at 31st December 2017. And PICO had marketed those goods up by 25%. We're going to come to this. What we are seeing here is a case of intra-group trading. The first one took place between the subsidiary and the parent company. And then we have the situation where the parent company also sold to JCO. All right, all of those profits that are unrealized will be cancelled out. Now, the goodwill in ESCO is impaired and should be fully written off. An impairment loss of 184,000 naira is to be recognized on the investment in JCO. All right. Non-controlling interest is valued at full fair value. ESCO shares were trading at 1 naira 60 kobo just prior to the acquisition by PICO. All right. So what we're going to do is this. We're going to take this up one by one. And then this is already giving us the sign of a typical, what is it called now? A typical examination question that we could possibly face. All right, so let's pay attention. We're going to start with the group structure. So what is the group structure we have here? The group structure we have here is, first of all, let's deal with PICO in ESCO. PICO in ESCO. Now, the person told us that PICO made investment and bought 1.2 million shares. All right, 1.2 million shares in ESCO. Now, all the shares we have in ESCO, if you go to your statement of financial position, you see share capital 1 naira per share. Under ESCO, you see 2 million, 2,000, but naira abbreviated into 3. So this is 2 million shares. Multiply that by 100, you get 60%. 60%. So PICO's investment in ESCO is 60%. All right. Now, don't you forget as well that they mentioned to us that there was a pre-acquisition reserve What did they say about that? They told us, see the A additional information. Pre-acquisition retained earning was 400,000 naira. So with this information now, and the other subsequent information I was given in B, I think I am ready. I am ready, I'm fully ready to go into the calculation of my goodwill. I'm ready to go into the calculation of my goodwill. All right. Now, but pay attention to this. We are going to have the following adjustment. We're going to have the following adjustment. Number one is that we're going to have this 800,000 naira as a fair value adjustment. Meaning it is going to show up in the calculation of my goodwill. Number one. Now, how do I go about treating that? I'll go about treating that. They said it is coming from freehold property. So I'm going to debit freehold property, 800,000 naira. All right. And then I'm going to credit fair value reserves, additional 800,000 naira. All right. Now, somebody will say, what are you now going to do about the depreciation on the freehold? All right. So 50% of it is depreciable. All right. Depreciable freehold property equals 50% of 800,000, and that is equal to 400,000. Annual depreciation will be equal to how much? This 400,000 divided by 50. And that should amount to 8,000 naira. So now what do I do about this? I need to do my count. First of all, what year did we make this acquisition? When did we make this acquisition? We made this acquisition 1st January 2010. All right. So my accumulated depreciation, I have to count it from that day. Now, what is the date of my consolidation? The date of consolidation is 31st December 2017. So if I count, I will count January 1 to December 31st, 2010. That one alone is 1 year. Then I'll count 2011, 2012, 2013, 2010, 11, 12, 13, 14, 15, 16, 17. I'll count 8 years. So accumulated depreciation ought to be for 8 years, which is equal to 64,000 naira. $64,000. All right. Now, how would I account for this 64,000 naira? Very easy. All of those depreciation yearly should go to P or L. So when you accumulate for all those years, if you must do, I'm sure you have done IES 8 with Mr. Wasiu. If you have to go back retrospectively to consider this because we are doing consolidation. What it means is that the group retained earnings will take 64,000 naira there. And then we credit the property with the 64,000. All right. Now, this is clear, but let's go ahead and do our goodwill. Let me ask, is this understood? Is this understood? What we've done here so far is what we have done before in one of the questions we had. Is this clear so far? You can use the chat box. So. All right, I'll move on. Consideration that was paid in 2010 by PICO. PICO paid a consideration of how much? How much was paid? Investment in ESCO.
2 million.
2 million naira. So NCI, we are told not to bother ourselves. They gave us the share price of NCI and they told us it is the policy to do full value. Okay, now NCI would have owned the remaining 800,000 shares. How did I know this? If ESCO has 2 million shares and PICO bought 1.2, then the remaining will belong to non-controlling interest, which is 800,000. Now 1.6 times 800,000 should give me how much? That should give me 1,280,000.
Okay.
Sorry, sir. How did you get 1.6?
1.6 is the last additional information we're given. They told us non-controlling interest is valued at full fair value. ESCO shares was trading at 1.60 naira just prior to the acquisition. All right. All right. Okay, let's move on. And then net asset acquired. Ordinary share capital of ESCO, if you look at the statement of financial position, is 2 million. Now, the pre-acquisition retained earnings, according to the question, additional information A is 400,000. All right. And now we have been told that there was fair value reserve. Fair value reserve of how much? 800,000 naira. All right, if I put all of this together, that should amount to 3.2 million. And then I am left with goodwill on consolidation. Now, you've done a good job if you have done this. However, you must pay attention to is it the last information? The second to the last additional information. They told us, they mentioned it to us, that ESCO's investment in ESCO should be, the goodwill arising from it should be fully impaired. All right. So what do? I say impairment. By doing this, I am taking out my goodwill. I am crediting goodwill. What will I debit? What will I debit? I am going to debit group retained earnings and NCI. Who can tell me why I am going to debit NCI? Why am I not this impairment? Why is it not that only parent is suffering it? Why is it the parent and NCI that are suffering it? This is a simple test of knowledge of what we have been saying in class. Anybody want to try? Because I must not forget. If I forget to treat this thing, my SOFP will not balance. It won't balance at all. It will not balance at all. So much. Why am I going to treat it between, why am I going to split it between NCI and payment? The reason I'm going to do that is simply because NCI was measured at full value, at the full or fair value, meaning that it is not owns this goodwill. All right, not only the parent owns the goodwill. The goodwill is to be shared between the parent and the subsidiary. Now, if it was net, if it was proportionate share of the identifiable net asset of the subsidiary, if that was the policy to measure NCI, then NCI would have no business sharing in this impairment, all right? But we have said it before, whenever the policy is full of fair value, then it means that NCI also owns part of the goodwill. So therefore, if there's any impairment of goodwill, both NCI and the parent will suffer that impairment. All right, is that clear, everybody? Is it clear? Can I move on? What's the other thing we're here to deal with? Because one way or the other, I've dealt with a portion of the second to the last additional treatment. Okay, let's move on forward. We're now told that PICO, I'm going to have to erase this board. Can I go ahead? Can I go ahead? When we are done, don't worry, we are going to go back to the solution when we are done. I just want us to walk through the solution together. The solution is already in the material, so we just walk through it. So I'll just have to move on. Okay. So the next item of information, we were told that PICO has also acquired 450,000 ordinary shares in JCO, but this time around on 1st January 2016, 1 million naira, when the retained earnings of JCO were 300,000 naira. All right. So what this means for us is that PICO bought in JCO. They bought in JCO. Now, how many shares do we have in JCO? We have 1,500 or 1.5 million. So if they bought 450,000 shares, all over 1.5 million times 100. How much is this in percentage? That's 30%. All right. Now, this 30% that they have bought, as of, you must also bear in mind, what is the date of acquisition? They said January 1, 2016. What was the reserve? Reserve as of that day was equal to 300,000 naira. So that when I want to calculate the post-acquisition retain, I'm going to deduct, if I'm looking at the SOFP that I have in the question, they have 780,000 naira. The only portion that PICO can share in will be 780 minus 780. Yeah, 780 minus 300,000. We'll come back to that. We're going to come back. Now let's go to the aspect where they traded with each other. All right. We're told that PICO, ESCO manufactures a component used by both JECO and PICO. All right. Now, we're also now told that ESCO sells this component at cost plus 25%. All right. Now, PICO held 200,000 naira inventory of this component at 31st December 2017. All right. Now, you must understand that what we have here is intra-group trading, and the fact that a portion of that good is still remaining unrealized profit, is still remaining in the group, in the book of PICO. It means they have an unrealized profit. Now, bear in mind that when PICO would write the amount in their book, they told you that ESCO has put a profit loading of 25%, meaning that this 200,000 naira in the book of PICO is sales price. All right. However, what we were given was a markup of 25%. So we said for you to calculate on selling price, it has to be margin, profit margin. You can only use profit margin on selling price. So my margin will be equal to 25 all over 100 plus 25, which is 25 over 125. Now, the unrealized profit here will be equals 25 over 125 multiplied by 200,000. This is 1 over 5, so this will be 40,000. Now, this 40,000 is what I'm referring to the other time as well. That whenever you have to eliminate, whether it is impairment in goodwill or it is a profit that you have to eliminate from the subsidiary, because you must pay attention to what the examiner tells you about NCI. Now, the fact that examiner told you that NCI is to be measured at full or fair value. What that translates to is that this unrealized profits, I'm not only going to eliminate it in the book of the parent, I am going to eliminate it in the book of both the parent and the subsidiary, and the NCI, all right? So how do I go about that? Very easy.
Very easy. It simply means that PICO has 60%. All right. $24,000 will be eliminated in the book of the group. The remaining 40% will go to the NCI. Now, this may not reflect very well because when we get to group retained earnings workings, we'll just do the adjustment under ESCO. So it may not be so clear, it may not be so obvious, but that is what it means. It means that only 24%, 24,000 is going to be what you're going to be debiting from the parent or from the group, while the remaining will go to NCI. All right. Now let's go to what happened between ESCO and people and JCO. Now, what they have on sold, just like similar situation, is 160,000. All right. There's a slight difference here. I'm going to use the same margin. All right. 25 over 125 times 160,000. Now, this is as good as saying 160,000 divided by 5, right? That should be how much? 160 divided by 5. 3 to 32,000. Now, don't forget what we said. Of this 32,000, we can only eliminate to the percentage of the holding of the investor. Percentage of holding is 30%. Do 30% of this. 32 times 3 is 96, so 30% should be 9,600 naira. Now, this 9,600 naira, the double entry for it, we mentioned it the other time. You're going to simply say, I cannot possibly credit inventory. What I will credit is the carrying amount of my investment in associates. And then we debit the group retained earnings. All right. Now, all of that will go under PICO when we get to retained earnings. All right. Okay. I think that's the most complex. That's likely the most complex of all the additional. Do we have any other thing left? Okay. All right. I don't have so much space, but we can quickly do something here. We can do investment in JCO. Let's do the carrying amount. All right. Investment that we made in 2016. How much investment have we made? We're told that's the third. We're told that we invested 1 million naira. Now, share of profit in associates. I said it would be 30% of post-acquisition. Post-acquisition will be 780 minus 300. Right? 30% of 580. What do we have? Are we still in this class? I'm going to round up very soon. Just stay with me.
Yeah, with you, sir.
All right. So what is 30% of 580? We said we are together. Or
174.
580. 174,000. All right. Meaning what we would have accrued here is this over the years. All right. But then don't forget, unrealized profits will be cancelled out. Unrealized profits we calculated was 9,600. All right. What else? We're told that there's going to be an impairment. If you look at the second to the last additional information, we mentioned impairment of 184,000 naira. All right. These are going to be deducted. What do we have there? 1,174,000 minus 9,600 minus 184,000. What do we have, please?
$980,400.
400.
9 how much?
980,400.
$980 or $950? Hello, can you? 980. Okay, I've seen where the problem is. This is supposed, I said multiply by, I said 30% of 580. 780 minus 300 should be 480. So it should have been 30% of 180,000. So what we have there is 144,000. What I should have here is 1,044,000. 1,144,000. And that will give us 950. That explains the 30,000 naira difference. All right. Now, 950, 400. Okay. Another thing we can quickly do, I think I can manage this space to do that. Very important thing to do is retained earnings. The group retained earnings. So I will have for PICO and I will have S. I don't really think I need for JCO. The solution shows for JCO. I can do without it. I can very much do without it. All right. Now, this is the retained earnings that we have in the book. In the book, we have PICO at 2,920,000. We have ESCO at 1,770,000. Now, pre-acquisition, we're told ESCO at 400,000. All right. Now, any adjustments I have that should affect both PICO and NCI, I said always treat it under ESCO, under the subsidiaries where you should treat it, so that you will not have to do this one I did here. You won't have to do it. It will already be implied in what you're doing. You won't have to bother your head about, if I break it down, the elements that is supposed to go to parents and the elements that should go to NCI. You won't have to bother about that. So all you will just do is to treat it under ESCO. By the time you are Now sharing whatever is left, you have already shared to PICO and NCI. Or you can decide to break it down one by one. But breaking it down one by one, you must remember all of the breakdown. Okay? So let's take the easier route. What are those things? Unrealized profit. It was ESCO that sold to PICO. So that profit is still sitting in the book of ESCO. Just like the inventory is still sitting in the book of, what is it called now? Of PICO. So we want to take out that profit. That profit that is unrealized is 40,000. So I'll take out all of the 40,000. All right. And then the additional depreciation, we said, since that fair value reserve was coming from the book of ESCO, all right? So even though we already have analyzed that it is going to go to both NCI and PICO, I said, to make life easy, treat it here under this place, okay? Then don't forget that goodwill was impaired. And I also said that that goodwill must be shared between the two of them. Because it must be shared between the two of them, bring it under ESCO as well. And then what you have left is going to be 1 million. I'm just taking it from the solution now, 1,186,000, okay? Now, parent does not have any acquisition retained earnings, okay? Now, but don't forget that parent will also have an unrealized profit in associates. This one that we limited to 30%, 9,600 will be deducted, right? Now, the impairment of goodwill in associates will only go to the parent. NCI does not have any business with that. Impairment in associate investment, 184,000, only belongs to the parent as well. Now they can get their share. Okay, let's start with share of profit in associate. They're going to get 950,400 from there. Sorry. 144,000. Abi? 144,000. 950,400 is the carrying amount of investment in associates, not share of profits. Okay, I have to correct that. Now, share of profit in subsidiary. What do we have left here? 1,186,000. So they add 60% of that. They're going to take 60% of that. 186,000. All right. And from what we have here, that's 474,400. That is how they came about. 1,754,400. Okay, so that we can round up fast. That is all that needs to be done. We've done goodwill, we've done all of the adjustments. Okay, so this is how it will be done. What is the thing that you must get used to from here is how we're going to take into cognizance all of the adjustments you have done. All of the adjustments you have done. If it is to, so what I would advise, unfortunately, this board is not big enough. If I were you in my exam hall, I will make a particular number of lines. I could count like maybe 14, 15 lines for group retained earnings. I put it separate. Investment in JCO, I could do like 10 lines separate. I would have opened it down so that as I am doing my workings, anything that ought to go there, I'll mark it. I can just put a small writing there. This goes to group retained earnings. This goes to investment in JCO so that I don't forget those adjustments. All right. Okay, so that will be all for tonight. I can just take it back to the solution. And then you will realize that all that we have done is what they have just characterized here. You will recall we had, after adding only parent and subsidiary, the 800 fair value reserve is here, and then the deduction of the additional depreciation over the years. Okay, another thing worthy of note is that you did not have goodwill. Why? Because all of the goodwill has been impaired. And the only goodwill that will show in consolidation is the goodwill that we have on acquisition. All right. Okay. That has been fully impaired, so it's not showing here. That's why it's not showing. And then our investment in associates, the carrying amount that we worked out is what you're showing, what is being showed here. All right. Then when we come to inventory as well, for our inventory, we added parent and subsidiary inventory balances. And then what we did was to take out the amount that is in the book of the parent, the 40,000 naira unrealized profit. Now, the other 40,000 naira unrealized profit, I said it, you cannot come to inventory to take care of that. The reason is because that inventory balance is in the book of the associate, and you are not consolidating associates. So therefore, it can never ever come here. It can never ever come here. And don't even forget that you have taken it here. You have brought it here. In place of inventory, what you did was you treated it under investment in associates. All right. And then the rest is easy. You just come to your retained earnings. And then your non-control, okay, we didn't look at NCI. All that would have been done to NCI is the NCI we had at, what is it called? At acquisition. Now, by taking only 40%, 40% is the holding of NCI. By taking only 40% of the post and adjusted retained earnings of the subsidiary, which we have already adjusted, we've done all the necessary adjustment. You just take 40% of whatever is left. And that's how we get it. Right? So that's it. It's as easy as that. In the next class, we are not going to jump into SOPL like that, although I would have preferred that we treat it at once. But we'll not jump into it like that. I'll make sure we solve one past question, and that past question will have associates in it. So I know that's going to take a lot of time. That's how I would have preferred a special. I would prefer a special time for it. So maybe we can do that on either Thursday or Friday. I'll make inquiry with Mr. Wasil. If we can have it on Thursday or Friday, it will be perfect. So that when we come to class on Tuesday, next week Tuesday, our focus will be on statement of profit or loss. All right. Thank you very much, everybody. I hope this is clear.